A letter arrives. Your insurance company is not renewing your policy. No claim, no missed payment, maybe nothing you personally did wrong. The carrier is simply pulling back from your area, so you turn to the backup, the California Fair Plan. The thing that's supposed to catch you when the regular market says no. Except now, there's a problem. Starting October 15th, 2026, Fair Plan dwelling rates are going up by about 29% on average. The backup is getting more expensive too. And if you watched the last video, you know the frame. Insurance is a second price tag on the house. It changes the monthly payment, the closing math, and sometimes whether the house still works financially at all. So what the Fair Plan actually is, why this jump matters, where it lands hardest, and what buyers, sellers, and homeowners can do about it. Let's go. The Fair Plan is not the insurance company most people choose first. It's the option of last resort, a state-created pool backed by the private insurers operating in California for properties that cannot find coverage in the regular market. You don't shop your way into it. You land there when the normal market has already said no, which also means it is not a normal homeowner's policy. A standard Fair Plan dwelling policy is built around fire and a limited list of basic property risks. No liability, no theft, not the full package most people picture. So most Fair Plan households carry a second policy alongside it, a difference in conditions wrap, just to fill the gaps. 2 policies, 2 bills. The Fair Plan was designed as a temporary bridge until a regular carrier comes back. Look at what it's become. As of this spring, the Fair Plan reported more than 680,000 policies in force across dwelling and commercial lines, up more than 150% in about 3.5 years. For a growing share of California, the last resort is no longer the last resort. It's just the insurance. So now, the rate increase. After the Los Angeles fires in January 2025, the Fair Plan filed for its largest dwelling rate hike in years, almost 36% on average. The state insurance commissioner reviewed it and trimmed it. What got approved is about 29% on average, starting October 15th, 2026. Hold on to on average. We'll come back to it. When a regular insurer raises prices, some homeowners can still shop around, but many people on the Fair Plan have very limited room to do that. People are there because the regular market already became unavailable or unaffordable. So when the backup raises prices, there is often nowhere left to go. For a household already stretched, that's a budget shock, landing on people with the fewest alternatives. The real cost of a home is the mortgage, plus property taxes, plus insurance. The listing price doesn't show this. Your pre-approval will not warn you either. The insurance quote is where the real number shows up. So this isn't a line item moving. It's the monthly cost of specific California homes moving, with no change to a single listing price. Now connect this to the closing table. A lender requires active insurance before funding a loan. No policy, no mortgage, no sale. Picture a buyer in a higher risk area. The regular carriers say no. What's left is the Fair Plan, plus that supplemental wrap to fill the gaps. 2 premiums stacked on top of the mortgage and taxes. Now run the monthly math. If that combined number pushes the payment past what the buyer can carry or what the lender will approve, the deal doesn't close. The house didn't change. The list price didn't change. The insurance math changed. This is the mechanism from the last video. The California Association of Realtors found the share of deals falling out of escrow over insurance roughly doubled in a single year. A Fair Plan rate increase feeds that same machine. So this is not only a homeowner issue, it's an escrow issue. Here's the part the headline number hides. 29% is an average. Almost no one pays exactly that. The biggest piece of the increase sits in the wildfire portion of the premium. So properties with serious wildfire exposure are likely to see larger jumps. Lower risk properties may see smaller ones. And some policyholders, the FAIR plan itself says this, may actually see a decrease. What drives the difference? Zip code, brush exposure, roof condition, distance to fire risk, and whether regular carriers are still writing policies in that area. So don't read this as one statewide story. California is not one insurance market. It is being sorted property by property. And this rate change sharpens that sorting. Let's make this practical. Quick caveat. This is general information, not personal insurance, real estate, or financial advice. Your situation depends on the property, the carrier, the lender, and local rules. So talk to a licensed insurance agent or a qualified professional before deciding anything. If you're buying, get the insurance quote early, before you remove contingencies, not after. And ask one specific question. Is this quote standard coverage, FAIR plan, or FAIR plan plus a supplemental policy? Those are three very different monthly realities. Then put that number next to the mortgage and judge the house on the full payment. If you're selling, insurability is now part of marketability. A buyer who can insure your house or can't afford to may not be able to close on it. Learn the insurance picture on your property before you list, if you can. A surprise in escrow is the expensive kind. If you already own, especially on the FAIR plan, sit down with a licensed agent. Get clear on what your policy does and doesn't cover. Ask about supplemental coverage if you don't have it. And work the one lever you control: mitigation, defensible space, roof condition, ember-resistant vents, brush clearance. Then document the work. The FAIR plan says the largest component of this increase relates to the wildfire portion of the premium, and that is also where hardening discounts can matter. It won't fix everything, but it's the part that's in your hands. So step back. The FAIR plan was supposed to be the fallback. But when the fallback gets more expensive, it stops being just a backstop. It becomes part of the affordability problem. California housing is being repriced by risk, by zip code, by insurance access, by monthly payment math. So the question is no longer only, what is the list price? It's, what does it cost to insure this specific property? Because in California now, the backup plan has a price tag too. If you're in California, drop your county or metro in the comments. Are you on the FAIR plan? Were you pushed toward it? Did your quote jump? Did a deal change because of insurance? No addresses, no exact dollar amounts, just the local red. That's what tells me where to dig next. And subscribe so you don't miss it when your county comes up.